Hi friends, in this module we will discuss on chapter 3 question number 44 to 46 on admission of a partner. Before we move on to the question, if you haven't subscribed to this channel yet, please do subscribe so that you can get notified whenever a new topics are posted in YouTube. Okay, let's move on to question number 44. A and B share profits and losses in the ratio of 3:2. They decide to admit C for 1/3 share. On this date, their balance sheet disclosed the following items: investment fluctuation reserve 40,000 and investments at cost rupees 3 lakhs. Okay, and they show the accounting treatment in the following cases. There are a few cases mentioned, so let's understand the question a little better. We have two partners, A and B. Their profit sharing ratio is 3:2. They admit a new partner C for 1/3 share of profit. The balance sheet as on the date of admission, it had investment fluctuation reserve account 40,000 rupees credit balance, and then investment, which is an asset, 3 lakh rupees. That's the cost. Okay. Now show the accounting treatment in the following cases. If the market value of the investment is 2,90,000. So the first case is the market value is 2,90,000. Now we know the book value of the book value of the investment, which is 3 lakhs. It's mentioned here in the balance sheet. It is 3 lakhs. The market value is 2,90,000, which means that we incurred a loss here. That is 3 lakh book value minus market value 2,90,000. The loss that we incurred is 10,000. The value of the investment comes down by 10,000. So in this case, the journal entry will be investment fluctuation reserve account debit. We have 40,000 in investment fluctuation reserve account, 40,000. Then we have to bring down the value of investment by 10,000, because now the book value is 3 lakh, whereas the market value is only 2,90,000. So two investments, 10,000. Then the remaining amount, that is 40,000 minus 10,000, 30,000 will be distributed to partners' capital, to A's capital, to B's capital, in their original profit sharing ratio, which is 3:2. That is 18,000 and 12,000. Okay, then there is second case. Second case says if the market value of investment is 2,45,000. So here market value of the investment is 2,45,000, and so in this case, what's the loss here? Loss is 3 lakh, which is the book value of the investment, minus market value, which is 2,45,000. The loss here is 55,000, but we only have 40,000 rupees in the investment fluctuation reserve account. So in this case, what will be the journal entry? So investment fluctuation reserve account debit, the entire 40,000 has to be written off. So 40,000, and the loss is 55,000. So 55,000 minus 40,000, it is 15,000. So that we will put on revaluation account. Revaluation account debit 15,000. Now we can bring down the value of the investment to investments by 55,000. Okay, third scenario, if the market value of the investment is 3 lakhs. So in this case, market value is 3 lakh, book value is also 3 lakh. that we have in our balance sheet. So in this case, there is no profit, there is no loss. The complete investment fluctuation reserve fund can be distributed to partners' capital in 3:2 ratio. So the journal entry will be investment fluctuation reserve account debit 40,000 to A's capital to B's capital, going to be 24,000 and 16,000 if it is 3:2 ratio. Then we have a fourth case. It says the investment, if the market value of the investment is 3,25,000, here there is an increase in the value. 3 lakh is our book value, the market value is 3,25,000, so we are getting a profit here of 25,000. So in this case, the journal entry will be investment fluctuation reserve account debit 40,000. We can completely distribute this to the partner's capital, as well as we have to increase the value of investment because it increased by 25,000. So investment account debit 25,000. The increase in the value of investment has to be, it's a revaluation profit, so revaluation account 25,000. The remaining 40,000 can be distributed to partners' capital, to A's capital, to B's capital, which is 24,000 and 16,000. Now, whenever there is a revaluation account involved, we have to distribute the revaluation account balances to partners' capital. So here revaluation account is credited, so we will reverse it. Revaluation account debit to A's capital to B's capital. Now revaluation account, it is 25,000, so it is 25,000 distributed in the old profit sharing ratio, which is 3:2, that is 15,000 and 10,000. So this question 44 is completed. Let's move on to the next question here. 45. Charu and Deepika were partners sharing profits in the ratio of 3:2. On the date of Isha's admission, the balance sheet of Charu and Deepika disclosed general reserve 1,20,000, debit balance in profit and loss account 40,000, investments 2 lakhs, and investment fluctuation reserve 60,000. The following was agreed on Isha's admission. Isha will bring 3 lakh as her capital and her share of goodwill premium in cash. Goodwill of the firm is valued at 1,80,000. The market value of investments was 2,30,000. Pass necessary journal entries. Okay, so here we have two partners, Charu and Deepika. The profit sharing ratio is 3:2. They admitted Isha as a new partner. After admission, the new profit sharing ratio became 4:3:2. And Isha is also supposed to bring a capital of 3 lakh and her share of goodwill. Her share of goodwill is not mentioned in the question, so we have to calculate her share of goodwill. Okay, now at the date of admission, the balance sheet of the firm showed the following. There is a general reserve of 1,20,000. There is an investment fluctuation reserve fund of 60,000. P&L account debit balance. Debit balance means it should be in the asset side, 40,000. Then we have an investment which is 2 lakhs. Now first we need to calculate the goodwill that Isha has to bring. Okay, how we will calculate that? We know the goodwill of the firm. Goodwill of the firm is mentioned, it is 1,80,000, it's mentioned here. So we will calculate Isha's share of goodwill here. Okay, first goodwill of the firm. It is 1,80,000 mentioned in the question. Now we have to find Isha's share of goodwill. Isha's share of goodwill. That is equal to 1,80,000 multiplied by her share of profit. Now the new profit sharing ratio is 4:3:2, which is 2 by 9. So multiplied by 2 by 9, that is equal to 40,000. So Isha has to bring 40,000 as her share of goodwill. Now we calculated her share of goodwill, which is 40,000. Now we have market value of investments. Market value of investment. That is also given in the question, which is 2,30,000. And the book value of investment is mentioned here. If you see, it is only 2 lakhs. Now the market value is higher than the book value, so investment value will increase. So what is the profit that we got from this? Okay, let's say the profit on this is basically market value, which is 2,30,000, minus the book value, which is 2 lakhs. That is equal to 30,000. Now we should put the journal entries. First, Isha is bringing in capital of rupees 33 lakhs and 40,000 of goodwill. So the journal entry for that. Before that, we should also calculate the sacrificing ratio. Okay, sacrificing ratio, because we will have to distribute the goodwill to all partners in sacrificing ratio. So we have Charu and we have Deepika. Okay, the old profit sharing ratio of Charu is 3 by 5 and the new profit sharing is 4 by 9. Okay, we have Charu 3 by 5 minus 4 by 9. That is equal to 27 minus 20 by 45. That is equal to 7 by 45. Then for Deepika, the old profit sharing ratio is 2 by 5 and the new one is 3 by 9. Okay, so it is 2 by 5 minus 3 by 9. That is equal to 18 minus 15 by 45. That is equal to 3 by 45. So the sacrificing ratio between these partners is 7:3. Now we will start passing the journal entry. Okay, first entry is capital brought in by the new partner. So bank account debit. It's going to be 3,40,000. 3 lakh as capital. So to Isha's capital, 3 lakhs, and to premium on goodwill, 40,000. Now this premium on goodwill has to be distributed to all partners in their sacrificing ratio. Okay, so that is premium on goodwill account debit, 40,000 to Charu to Deepika. That is 28,000 and 12,000. Now we should see the items in balance sheet. We have P&L account here, and we have general reserve as well. So general reserve and P&L account, let's write it off to the old partners in their old profit sharing ratio, which is 3:2. Okay, so it's going to be general reserve account debit 1,20,000 and that towards partners capital, to Charu's capital, to Deepika's capital. Then old profit sharing ratio is 3:2, so it is going to be 72,000 and 48,000. Now P&L account has a debit balance, so partners capital has to be debited. Charu's capital account, Deepika's capital account, debit to P&L account. So P&L account balance, it is 40,000. So it is 40,000. This will be divided to partners capital in 3:2 ratio. So that is going to be 24,000 and 16,000. Then we have investment fluctuation reserve account. So investment fluctuation reserve account is 60,000, and investment here it is 2 lakhs, and we also have a market value of investment which is 2,30,000. We made a profit of 30,000. So here we have to increase the value of investment by 30,000. We have to write off the investment fluctuation reserve account to the partners capital account. So the journal entry for this is investment fluctuation reserve account debit 60,000. Then investment has to be increased by 30,000. So investment account debit 30,000. Then whatever profit we got, the investment increased by 30,000. So that is a profit. So that will be towards revaluation account. To revaluation account 30,000. To Charu's capital, to Deepika's capital. So 60,000 divided among two partners in their profit sharing ratio, which is 3:2. So that will be 36,000 and 24,000. Then whenever there is a revaluation account involved, the balance of revaluation account has to be moved to partners capital account. So it is going to be revaluation account debit to Charu's capital to Deepika's capital. So revaluation account balance, it is 30,000. So 30,000. If it is divided in 3:2 ratio, it's going to be 18,000 and 12,000. Okay, so we completed question number 45. Let's move on to question number 46. Here A, B, C were partners in a firm sharing profits and losses in the ratio of 2:1. their balance sheet as at 31st March 2018 was as follows. There is a balance sheet given, and then they admitted D into partnership for 1/4 share on 1st April 2018. Give necessary journal entries to adjust the accumulated profit and loss. So here we have three partners, A, B and C. Their profit sharing ratio is 2:2:1. They admitted a new partner D, and his share is 1/4 of the profit. Then we have to have a look at the balance sheet. So here on the liability side we have general reserve 40,000. This needs to be distributed. We have workman compensation reserve 35,000. This needs to be distributed. We also have investment fluctuation reserve 10,000. This also needs to be distributed to partners' capital. Now on the debit side we have something called investment, and they also mentioned the market value of investment is 32,000, even though the book value is stated as 40,000. Then we also have profit and loss account debit balance of 20,000. So whichever it is highlighted in yellow, this needs to be accounted now. Now first we will put journal entries to transfer these funds. Okay, the journal entry will be, we have general reserve account debit. We have 40,000, yes, 40,000. Then we have workman compensation reserve. So workman compensation reserve account debit 35,000. Okay. Now we also have on the credit side we completed this one and this one, and this one we will wait to adjust the investment. So we can also put the P&L account. So to P&L account 20,000. So 40,000 plus 35,000, it is 75,000 minus 20,000. It's going to be 55,000. The 55,000 has to be distributed to partners in their old profit sharing ratio, to A's capital, to B's capital, to C's capital. Their old profit sharing ratio is 2:2:1. So if 55,000 it is divided in 2:2:1 ratio, it's going to be 22,000 for A, 22,000 for B, and 11,000 for C. Then we need to have a look at the investment fluctuation reserve and the difference between market value and book value of investments. Now the book value of investment is 40,000, market value is 32,000. So here we incurred a loss of rupees 8,000. So the journal entry will be investment fluctuation reserve account debit 10,000. Investment value has to be decreased by 8,000. So to investments 8,000. Then the remaining amount 10,000 minus 8,000, which is 2,000, that needs to be distributed among the partners in their old profit sharing ratio, to A's capital, to B's capital, to C's capital. Profit sharing ratio is 2:2:1. So it's going to be 800, 800 and 400. Okay. So we completed question number 46. So friends, if you haven't subscribed the channel, please do subscribe so that you don't miss out on further questions. Thank you.